Hi everyone. In Chapter 4, we're going to be looking at sections A and B. I don't have my book in front of me, but I will do my best to get the pages that you're responsible for posted. But essentially, we'll be looking at the income statement, comprehensive income, and the statement of cash flow. We won't be doing any kind of ratio calculations in this chapter. We will come back to them, though, in Accounting 212. So, the income statement, remember, reports a company's profit or loss during a period of time. Comprehensive income goes to the next step of income. Income statement only reports revenues, expenses, gains, and losses that have actually occurred. There are other components of gain and loss or equity changes that are from non-owner sources that are not on your income statement. And we've talked about one of them already, the unrealized gain or loss from an available for sale bond. So if you have an artificial gain or loss because the value of the bond that's in the available for sale category increased or decreased, it's the only unrealized gain or loss that does not appear on the income statement. All the other ones do. This one goes directly to equity, and it's considered comprehensive income, but not part of net income. So comprehensive income starts with net income, because that is part of comprehensive income, all income. And then there's these other items such as unrealized gains or losses on available for sale bonds that aren't allowed on the income statement, but are part of equity. They increase or decrease equity. These items are included as comprehensive income. And there are other various ones that you will not really see and learn about until Intermediate Accounting 3. And then the statement of cash flow. Remember, this financial statement gives us detailed information about how the cash was spent in the company for the year. And you learn this in Accounting 112. So here's the example of an income statement. This is a multi-step income statement, the one we're used to when we are dealing with a company who sells a product. Notice we start with, and you see this major section in the red bracket, it's called Income from Continuing Operations. And this is the one you've seen so far. We start with sales revenue, subtract cost of goods sold to get the gross profit. We then subtract selling expenses of the company, general and administrative expenses, research and development expenses if the company has any, and something called restructuring costs. So we deal with something new here, restructuring costs. These are all considered operating expenses. They're subtracted from gross profit to get operating income. We then have other income and expenses that occur that are not directly related to our operations. Interest revenue. This is revenue we earn on an investment. Interest expense. This is an interest we have to pay on a financing item. Gain on the sale of investment. Sure, we made money on it, but that's not part of our normal operation. So we put these other items together and net their effect. So revenues would be added, expenses subtracted, and then either add or subtract to the overall amount. Notice, we call this income from continuing operations before income taxes. Okay? We take this income amount, calculate income tax on it, usually based on a percentage for our case, subtract that, and that will ultimately give us income from our continuing operations. That means these operations, all these items, are planned to be continued into the future. Now, not all companies will have this next section, but if a company is getting ready to get rid of, sell, or disband of a major component, we're going to talk more about this in detail. They separate those revenues and expenses out and categorize them on the income statement as income and expenses from discontinued operations. And you could see there's two major sections there. Loss from operating the discontinued component until it was sold. Loss on the actual sale of the discontinued operation. So these two items actually decreased our income and then arriving at net income. And we'll talk about why we separate that. Then on the bottom part, we have earnings per share. And this is a calculation that must be done. You learned this in Accounting 112. We're going to go through it again. But it must be completed for the major parts of the income statement and displayed as you see there. So let's take a look. That's the whole enchilada there. Income from continuing operations. This is where we report the revenues, expenses, and gains and losses that have occurred during the reporting period. Remember, inflows are from resources from providing goods or services. Outflows are the resources incurred while generating revenue. So these are things we have to pay for. The cost of providing goods and services. That's part of our normal operations, generally. And then we show some relationship here. When do we report the expenses? We've talked about this one already. Expenses that are directly related to or the result of revenues should be reported in the same accounting year. If they don't have a direct effect, we relate the expense to a particular period or time period it occurs. You know that already. Gains and losses, remember, are from those peripheral or once-in-a-while transactions. You might sell property, plant, and equipment or an investment at a gain or a loss. Those aren't part of your normal operating income, but they are part of continuing operations. They're usually reported in the other section. So go back to McAllister here. Here are our major operating items: sales revenue, cost of goods sold, our operating expenses. Restructuring costs are costs incurred by the company to change the company around. Maybe they combined departments. Okay, so they did something to restructure the company and it cost them money. That's considered an operating expense and it's included. Not going to happen all the time. They may never have it. But if they do have those types of costs, that's where it's reported. That gets us to operating income. Then we have the non-operating items that are considered continuing operations. They're part of our normal operations. Interest income, interest expense, gain on sale. This leads us to income from continuing operations before any income tax has been subtracted. Now calculate and subtract your income tax. That leads you to income from continuing operations. So when we talk about that, that's what we are focused on the income statement. Here's Home Depot. You can see the similar presentation there. Now, what we were looking at was a multiple step income statement. What you're seeing here is a single step. Single step is what we saw back in Accounting 111, and service companies can generally use this kind. All the revenues and gains are grouped together and reported. All the expenses and losses are grouped together and reported and subtracted. Income taxes then subtracted to get to net income. So, it doesn't give us a lot of information, doesn't help decision makers so much. It just tells us here's your revenues, here's your expenses, and that's where you ended up. The multiple step income statement gives us more information because it separately classifies our income statement by that operating and non-operating area. And it reports intermediate totals. Remember, it takes sales revenue minus cost of goods sold, gross profit. There's your first subtotal. Then it subtracts operating expenses to get your next intermediate subtotal, operating income. Then it subtracts or adds those other income or expense items to get our income before income taxes. So that's what they're talking about there, those subtotals. So there they are again. Gross profit, operating income, income before income taxes, and net income. Now, if you're sitting there going, well, why don't they have income before income on continuing operations before income tax? Well, if a company doesn't have any discontinued operations, they don't have to label their information on their income statement like that. It's only when a company has a discontinued operation that they have to identify the part that's from continuing operations and the part that's from discontinued operations. In this case, the company has no discontinued operations, so they can report their information just like that. Now, some differences between US GAAP and IFRS. Income statement presentation, there's no minimum requirement, but for IFRS, they require certain minimum information to be reported. The SEC regulations require expenses to be classified by function. There you go. IFRS allows expenses to be classified either by function or natural description. The bottom line of the income statement is either net income or net loss, and so is for IFRS. So pretty similar. So let's do a quick check. Which of the following captions would more likely to be found in a single step? Total revenues and gains, right? Yep. We take a step back before we go on to the rest of the income statement because there's something called earnings quality. And earnings quality is very important. When you see information on an income statement, you expect it to be able to help you predict the future. And it all really depends on the quality of that number. Is it really an accurate and true number? Now, sorry, I'm kind of going forward in my head here. What's important to realize is when you have a major segment of your company that you know you're not going to operate in the future. So say this year you say, we're going to sell our hotel division. You're not going to sell one of your hotels and continue to operate in the hotel industry. No, you're selling all your hotels. You now have a component of your business that's not going to be there in the future. You're still operating it. You're still trying to make money from it. But you know it's not going to be there in the future. We term that part of your company discontinued operations. And it's important that we don't include any of the earnings from that happened this year with everything else that will continue in the future because it's not going to be here. And that's what this slide is trying to depict. Stuff that's not going to be around anymore should be reported separate from stuff that will continue. I'm just going to skip over this for now because I want to keep going with what I'm talking about. So there's a lot of stuff in here that we can keep going. Because this slide is here, let me just focus on it for a few seconds. We already talked about it, but I want to get into discontinued operations. Restructuring costs. Remember we saw those on the operating section of the expenses? This includes costs associated with management's plans to materially change the scope of the business operation. So any costs with changing the business, you merge departments, you relocate something, that's a restructuring cost, and those are reported as operating expenses. Here's some more. Termination benefits payable to employees who are going to be terminated. Costs associated with closing a facility, not a whole segment, but one facility. Also included in operating income are what we call unusual items. Sometimes, and we'll be looking at this in more detail in the coming chapters, a long-term asset, maybe a piece of equipment or an intangible asset, has lost significant value, a real lot of value, for whatever reason, technology, just something has caused it to lose value. Well, we may have to recognize what's called a loss on impairment because of how much that value decreased. And we'll show you how to calculate that. That's considered an unusual item. Okay, and what else could affect our earnings quality? And we're still on, they're talking about earnings quality here, is a company loses a major customer that cannot be replaced. So I kind of got off the subject there. I apologize, I thought it was going in a different direction, but that's okay. We could talk about these things that really affect if the quality is there for the earnings, and it all depends. Okay, I'm not going to worry about that. Here's our non-operating section. Okay, I'm just going to I'm not too worried about this stuff. Again, restructuring costs. We have Buffalo Manufacturing Company is restructuring and closing the platinum mining division. The mine will be closed and its assets sold off over the course of the next 3 years. When should the cost related to the closing of the mine be recognized? B, in the year the costs are actually incurred. If you recognize them all in 1 year, that'll affect your earnings quality. So it's important. But this is what I wanted to get to, because although earnings quality is important, and read through that really well, we want to talk about the functions of the income statement so we know how to do one and why things are happening the way they do. So we looked at the continuing operations section of the income statement, right? Sales minus cost of goods sold gives us that first intermediate subtotal gross profit. Minus your operating expenses gives you operating income. Minus your non-operating, your other gains and losses, gives you your income from continuing operations before any income tax. Subtract income tax, and that will give you income from continuing operations if you have something called a discontinued operation. And the other major part of your income statement is this. So if a company decides to sell or dispose of a component of their business, profits from these discontinued operations will not continue, so they shouldn't be reported as income from continuing operations. The component of an entity or group of components has been sold, disposed of, or is considered held for sale. If that's the case, you keep track of revenues and expenses from that component separate from everything else. And you report it separate on your income statement. We don't want to include that information in continuing operations because it affects earnings quality. It makes it look like it'll be there in the future. No, it's not. You're selling it. You're still making money on it. You still have revenues and expenses related to it, but it's going away. So what do? After we report income from discontinued operations, we go, okay, what were the revenues and expenses this year for the discontinued component? And we say, okay, they were $200 profit in this case. We then figure out the income tax on that $200, subtract that tax expense, and add the net, 200 minus 50, because we haven't reported that income anywhere yet, that 200. So there was no income tax even computed on it. It's not up here in the 1,000. No, it's being reported separate. So we still have to determine the impact of taxes. The IRS doesn't go, oh, you have a discontinued operation? Don't worry about it. You don't have to pay tax on it. No, they still want their tax on that money. So we're going to subtract that, and it's the net that will increase our income from the discontinued component of our company. So when somebody's looking at this, if we didn't separate those two things out, that net income would look like it would continue in the future. No, no, no. 750 can continue in the future. The other 150 is going away. And that's why we separate them. So when the discontinued component is sold before the end of the reporting year, so in that example we saw it was still up for sale. But what if it's sold during that year? Well, not only will you report any profit or loss from the beginning of the year to the date of the sale during that year, but also any gain or loss on the actual sale. So you have two separate components. Take a look. In October, management of Duluth Holding Company decided to sell one of its divisions. That's a separate component according to GAAP. The division was sold on December 18th. So we don't go, oh, what was the revenues and expenses from October through December? No. You might have decided to sell it in October, but really, it's been making money since January. Get all the revenues and expenses from the beginning of the year through the date of the sale. It had a pre-tax loss, so before any effective income tax, of $5 million. When they sold the division, they sold it for $15 million. The book value of the assets they sold were $12 million. So they actually had a $3 million gain on the sale. What we do here is we're going to assume there's a 25% tax rate. So here's what happens. This company starts with income from continuing operations of $20 million. It already subtracted the income tax effect out. Now, the first thing we're going to do is report loss from operations of discontinued component. Okay, $5 million. Including gain on disposal of $3 million. So they're netting together here the $5 million loss and the $3 million gain. But we're letting people know, oh, overall, there was a $3 million gain when we sold it, but netting the operations and the sale gives us a $2 million loss. Now here's what's important. When you have a loss on your tax return, you get to deduct it usually. And in this case, they would. Now, if you deduct something on your tax return, you get a tax savings. So we call that an income tax benefit. A loss will result in you saving taxes, 25%. So the $2 million won't be subtracted from our income from continuing operations. No, because the actual loss is only $1,500,000. $2 million loss, but then a tax savings of $500,000. So now our loss is only at $1.5 million. So loss on discontinued operations, $1.5 million. Subtract that from your income from continuing operations to get your net income of $18,500,000. You see how keeping those two things separated can give a decision so much more information? If they were commingled together, it would look like net income could only be $18,500,000 in the future, when in fact it could be $20 million. That's why we do it. When the discontinued component has not been sold by the end of the reporting year, income or loss from the operations must be reported from the beginning of the year to the end of the year. And if necessary, an impairment loss has to be reported. When? If the book value of the assets is more than the fair value of the assets. Take a look. In October, Duluth is selling this division again. Here's what's happening. The loss for the year was $5 million. On December 31st, the division's assets had a book value of $12 million, but they were only worth $9 million. So if they sold them, they would only be able to sell them for $9 million. This is an impairment loss. This loss must be recognized now, not when the sale actually occurs. So if the opposite was true, there would be a gain and we still didn't sell them. We'd say, well, we'll just wait till the sale happens. But when your book value is more than your fair value and you haven't sold them yet and it's the end of the year, you have to write the assets down to their fair value. And that's what creates an impairment loss. Take a look again. We start with that income from continuing operations. We have our loss from operations of a discontinued component, $5 million, plus the impairment loss of $3 million, and we didn't even sell them yet. We'll have an income tax savings of $2 million because that $8 million loss will create a $2 million benefit. We don't have to pay that much in income taxes. So our actual loss on discontinued operations is $6 million. Wowee. Look at that net income, $14 million. And look what, if, like I said before, if these two things were commingled together, yikes. It would look like the company's only making $14 million in the future. No, they got rid of a $6 million dog, right? That part of their company that's been bringing them down. They're looking at $20 million in the future. Here's another one. Okay, this is the assets and liabilities held for disposition for Abbott Laboratories. They have assets $513, liabilities $245. Okay, and it's just not sure why exactly that was there, but we're going to keep going. I thought there was another example here, but let's take a look. The Kinsella Baseball Bat Company reported income before taxes of $375,000. This amount included a $75,000 loss on discontinued operations. How much should be reported as income from continuing operations, assuming a tax rate of 25%? All right. Well, $112,500. $375,000 before income tax, but there was a $75,000 loss on discontinued operations that was included. Add that back. It shouldn't have been subtracted. So now you're at a $450,000 income from continuing operations. Take 25% of that for tax, subtract it. Now your income from continuing operations, $112,500. Hold on one second. Something's not sounding right there. From continuing, yeah. 375 plus 75 times 0.75. Now, the amount of tax. So that slide is a little wrong. I don't know what's going on. 375 plus 75,000 will give you income from continuing operations of 450. Times that by 0.25, your tax is 112,500. Okay? It says the amount reported as income from continuing operations. No, that's the tax on the 450. Subtract the 450,000 from that. Well, 337,500 is the amount of income from continuing operations. Okay, so they got that a little jazzed. The 112,500 is the amount of tax on income from continuing operations. And you could ignore this 1 minus 0.25 because that will not give you 112,500. That should be 375 plus 75,000 times 0.25. That will give you 112,500. Then subtract that from 450,000 to get the income from continuing operations. I apologize for that. On October 1st, American Medical adopted a plan to discontinue its generic drug division, which qualifies as a separate component of the business according to GAAP. The disposal of the division was expected to be concluded by March 30th, 2022. December 31st, the following information relative to the discontinued division was accumulated. The operating loss was $195 million. The amount book value is greater than fair value was $25 million. In its income statement, how much would American report as a before-tax loss on discontinued operations? Well, the $195,000 loss plus the $25 million that the book value is above fair value. Remember, that would be considered an impairment loss. So you would add those two losses together. They wanted to know before income tax, so that's where you get the $220 million. But remember, on the income statement, we subtract out any tax savings from the loss, and then it's the net loss that's actually subtracted. Here's another one. Trident Corporation's results for the year ended December 31st include the following: revenues, cost of goods sold, etc. What are the income from continuing operations before income tax? So we'll take the $8,200,000, subtract our cost of goods sold of $4,800,000. That gives us our gross profit. Then we're going to subtract our $2 million in selling and administrative, and our $280,000 in restructuring. That will give us operating income. We then add our gain on sale of investment. That's still part of our continuing operations. So $1,420,000. This loss on discontinuing operations would occur after we report continuing operations. And there's the calculation. Okay, so that's our income statement. Fun stuff, right? We'll focus more on earnings per share. I'm not sure if they have anything else here in my slideshow or not, but if we come across it, we will talk about it. We probably will hit on it in our practice problem. Now it takes us into a totally different realm, accounting changes. Accounting changes fall into one of three categories. You could have an accounting principle change. You change from LIFO to FIFO or straight line to double declining balance. An estimate change. You could change the life of an asset from 5 years to 6 years, or change the salvage value. Okay, or there's a reporting entity change. You could change the composition of your company. Depending on the type of change will depend on how you account for it. And one of those items is the correction of an error. And this is another adjustment that is accounted for in the same way as certain accounting changes. So what happens if you have an error in a prior year? So let's first look at accounting principles. So when you change, refers to a change from one acceptable accounting method to another. There's different implementation approaches: retro, modified retro, and prospective. Sorry. If you have a mandated change, you must. You could take the approach where you can go back, recalculate all your transactions under the new accounting principle. You can modify that approach, or you could just start from today and change the principle going forward. That's when you're forced to change. But if you have a voluntary change, you just say, oh, I think we're going to change from FIFO to LIFO. Okay? You must make it retroactive. What does that mean? So for 5 years now, you've been using FIFO to account for your inventory. The beginning of year 6, you say, we're going to start using LIFO. Well, what you need to do is go back to year 1 of when you first started using the old method, the FIFO. Recalculate your inventory transactions as if you used LIFO. And then you can start using the new method. Why do you do that? Because your inventory and your cost of goods sold under the two methods will be different. And you want to start using LIFO with a good inventory balance, an inventory balance that would have resulted from using LIFO the whole time. So that's what they mean by a retrospective. If you change depreciation method, amortization, or depletion, and what we're talking about here is an estimate in those methods. So you're changing the salvage value or the life of the asset. You make that change going forward. You don't have to recalculate anything from the past. Okay? You say, okay, today we thought we were going to use that equipment for 10 years. We're only going to use it for 8 years. So we're readjusting the life of the equipment. You would make that change going forward. And there's a special computation you do to do that. That's what we're talking about here. Change in accounting estimate. Okay, another example is changing the percentage you're going to use for bad debts, for predicting bad debts. So we're just giving you a flavor. Sometimes there's a correction of an accounting error. So this is caused by transactions being recorded incorrectly or not at all. And if the error is discovered in the same year, just fix it. Fix it so that it's correct. But what if you find the error next year? Okay, we call these prior period adjustments. So you don't reopen the prior accounting year and redo your financial statements. No. Okay, you basically are going to make the correction and move forward. So here's what we do. When a material error is discovered in the statements that have already been published and distributed, the company will make a journal entry this year, not the year that it occurred, the error occurred, but this year. What they'll do is if a balance sheet account was affected, they will debit or credit that balance sheet account to make it correct, to fix the error. If the other part, if the other part of the journal entry was on an income statement account, those are reset to zero. You can't just go changing the balance. What we do is we adjust the beginning balance of retained earnings. We fix that as of the beginning of the year. So, example, you forgot to record an expense. Well, what does that mean last year? That means you didn't record enough in expense, so your net income was too high. If your net income is too high, you added too much to retained earnings. So the beginning balance of retained earnings is too high. What you'll do is debit retained earnings for this error correction this year. So that is a prior period adjustment. Earnings per share, here it is. It's a ratio that tells us the amount of income earned by a company for each share of common stock. There's two major kinds. You're not going to learn diluted earnings per share this semester, but basic you are. But both are reported on the income statement. And here's how you calculate basic earnings per share. Net income of the company. Remember, what's net income? It's the bottom line. It's all the income that's available to the shareholders. Now, if the company has preferred shareholders, remember, they're promised their dividend. They're normally cumulative, meaning if the company doesn't declare a dividend this year, they're still going to get a dividend. It gets added to next year and next year and next year until the company actually does pay out a dividend. So what we do is we say, okay, here's the net income, and that's what's available to all the shareholders. We got preferred shareholders. They always get their dividend first. So how much of the net income is automatically promised to them. And they know that. That is in their stock certificate. It's usually a percentage of par value. We'll be looking at that. So now we isolated just the part of net income that's available for the other shareholders, the common shareholders. And we divide that part of net income by what we call the weighted average number of common shares outstanding. So we do some averaging, especially if we are selling common stock throughout the year. We just don't go beginning of the year, end of the year divided by 2. We have to do some actual weighting of ownership of the shares throughout the year. But in the end, that's what we're calculating. We're taking the part of net income that's available to the common shareholders as a dividend, because it's only for them, and dividing it by the number of shares that are out and sold to those shareholders. Remember, it's outstanding shares. So if a company owns any of its own stock, those shares are not included as outstanding. So here's a company at $600,000 in net income. $75,000 of it is for preferred shareholders. As of the beginning of the year, I know this isn't here, but this is what this is saying. The whole year, the company owned 1 million shares of stock, or the whole year, the company had 1 million shares of stock outstanding. In April of this year, they sold another 1 million shares. So you see that 9/12? That's saying 1 million shares were sold, but they weren't outstanding the whole year. They were sold April 1st, so they were only outstanding for 9/12 of the year. So only 9/12 of them are what we consider weighted average, or 750,000. So we have the 1 million shares that have been outstanding all year, and then we have the additional shares that were sold this year, but we only account for the portion of the year they were outstanding. Multiply that by the total number. So 1,750,000 is the weighted average number of common shares. This would give us an earnings per share of 30 cents per outstanding share. And that's how we calculate it. Diluted is, just to give you an overview, when you hear the word diluted, you think of Kool-Aid, Kool-Aid, real Kool-Aid, is, they tell you a quart of water, sugar, and your Kool-Aid, right? Now imagine you used a gallon of water instead of the quart of water. You super diluted your Kool-Aid. You made it weaker. Well, that's the same thing we're talking about here. Sometimes companies offer crazy things to people. Like, for instance, and they talk about this, something called stock options. And just so you understand, a stock option, if you've never heard of it, allows the person who owns the stock option to buy the stock of the company at a lower price than it's currently being sold at. So a lot of times as compensation packages, stock options are given to executives. Here's a stock option. You could buy our stock at $10 when it's trading at $25. So now if you're sitting there like I was back in the day going, well, you still got to spend $10. Oh yeah, spend $10, but then get 25. You just made a profit of 15. So that's what stock options are. And they're just that. You don't have to buy the stock. It's an option for you to buy the stock. What diluted earnings per share says, let's pretend everybody who has stock options buys our stock. They just then probably sold more stock into the stock market if that happens. That will increase the amount of outstanding stock. We have more stock out there. What happens to our earnings per share? It's diluted. It goes down. It gets weaker. So what we do with diluted earnings per share is kind of a what if? What if everybody who could buy our stock because they got these crazy little options to do that actually did it? What would our earnings per share have been? Right now they're 30 cents. But how low would they go if everybody who could buy our stock because of these security options they have actually did? And we have to report that on the income statement. I know that sounds crazy. A what if? Exactly. We give as much information to decision makers as we can. Earnings per share is beyond the most important ratio for investors. They love earnings per share. They make decisions on it all the time. So if they're seeing, sorry about that, I've been storms here. If they're seeing that, hey, my earnings per share right now is 30 cents, but if all these people buy the stock who have the option to, it's going to go down to 15 cents. I don't know if I want to buy it. That's why we report it. So here is for Abbott, their basic and their diluted earnings per share. And it's the same. So they didn't have any in 2016. They didn't have any of those crazy stock options out there. Okay, all the stock that could have been sold was sold. But in 2015, it was a little different. They're diluted versus their regular. And you see, only when it's diluted, it goes down, it gets weaker, do we report it. Which of the following represents a change in accounting principle? B, changing inventory methods. Okay, now, so we've handled the income statement, and we've talked about those accounting changes, which was a bizarre place for the author to put that part of your presentation in, but we got it over with. Comprehensive income. Now, in the last few years, last 10 years, comprehensive income has in and of itself become its own financial statement, but we have options. Remember what comprehensive income is. It's net income plus all the other increases or decreases to equity that are not caused, by the owners. Here's some of those items. Net unrealized holding gains and losses on your available for sale bonds. Take a look at this. Gains and losses from post-retirement benefit plans. Okay, so there's certain gains and losses that could happen from a retirement plan that are reported here. Deferred gains and losses from derivatives. You're going to learn this stuff in Intermediate Accounting 3. Foreign currency translation adjustments. That's an advanced accounting course. So after all your intermediate accountings, you take this course called Advanced Accounting. If you're going for your bachelor's degree, that it's like a hodgepodge of things you still haven't learned about. And one of them is translating foreign financial statements into United States dollars. And when you do that, it could result in a gain or loss from translating. When that happens, it gets reported as other comprehensive income. Now here's our flexibility. We always show our income statement. Now you can make one big income statement and comprehensive income statement. So you would have your income statement and right after it add or subtract. So you would have net income, then you would add or subtract your items that are considered other comprehensive income to finish off your statement of comprehensive income. Some companies decide to split them. Here's our income statement, there's our net income. Here's a statement of comprehensive income. We start with net income, separate, and we add and subtract those items that are considered other comprehensive income that our company has. So one of two ways, and it's all the choice of the company. So here is a comprehensive income statement. Net income, That's that. So you did your income statement and you're at net income. Oh wait, no, I'm sorry. This is being reported separate. So comprehensive income statement, consolidated statement of comprehensive income from Astronova starts with net income. Here are our other comprehensive income increases and decreases. It looks like it's all decreases. So overall, all income, $4,147,000. So when you do a separate statement, that's how you would start with net income and then add or subtract those things that are considered other comprehensive income. You could report, or you have to report, other comprehensive income on a cumulative basis in the balance sheet. So we report this as an additional component of shareholders' equity. So if you have other comprehensive income items from prior years, they're accumulated over time. So here's our balance sheet, and you could see that. After the treasury stock, accumulated other comprehensive income for the year. So this company's accumulated other comprehensive income started at $975. This year's comprehensive income items that occurred this year, those unrealized gains and losses on investments, pensions, foreign currency translations, totaled 81 loss. So now our new accumulated other comprehensive income is $1,056,000. So current year adds to those accumulated items, and then they're reported separately in the balance sheet. Okay, so we're looking here at the relationship between net income and other comprehensive income, and here's your first alternative. Consider a $10 million net of tax gain. If reported as part of net income, the gain adds to the cumulative balance of retained earnings. So there it is. At 110, 770 plus 30, total retained earnings and accumulated other comprehensive income are 800. Instead, consider a 10 million net of gain tax, which instead is part of other comprehensive income. Overall, it's still 800 retained earnings and accumulated other comprehensive income. However, be careful. It's the 760 that's available to shareholders to be paid as a dividend. So where we report this is very important. Companies are allowed to report comprehensive income in a single statement or combined on their income statement, US GAAP. IFRS, it's the same thing. That's all you need to know there. Don't worry about the however. Which of the following is not an example of other comprehensive income? A. Jeez. Sorry. It's getting late in the day for me, and everybody's texting me now. Okay. So our answer is income from sales. That's part of our normal income statement, right? But all these other items are considered other comprehensive income. Okay. All right. So we're done with the income statement. We're done with comprehensive income. The last financial statement that we're going to focus on is the statement of cash flows. Everyone's favorite, right? Remember, all the statement of cash flow is telling us is how we spent cash, how the company spent their cash equivalents, okay, over the year. And it's helpful in assessing profitability, liquidity of the company, and long-term solvency. Can they pay their bills? Do they have enough cash? Where's their cash coming from and where's it being spent? Remember, we categorize the way we spend our cash and bring it in according to operating activities, investing activities, and financing activities. So a quick check here. I think it would be D. All of these things are true. Okay. So let's talk about what do we talk about operating activities? Here we're determining the amount of cash that came in and then the amount of cash that went out from our operations. Now remember, our income statement, which results in net income, is based on an accrual standard. There's items on that we haven't collected in cash yet or paid. So what we're going to do in our statement of cash flow is convert our net income from this accrual basis to net income like cash accounting was used. That's what we do in the operating section. So our major inflows are the cash we get from selling our goods and the cash we get from interest and dividends from our investments. The cash outflows from our operating activities are buying inventory, paying salaries and other operating expenses, paying interest on debt, and paying income taxes. When we net those two together, it gives us our net cash flow from operating activities, whether it be positive or negative. It doesn't always have to be positive, sometimes it's negative. Now, when it comes to the statement of cash flow, we have two different ways to report cash flows from operations. Most accountants use the indirect method because it's easy to do. It's pretty straightforward with how to calculate cash flow from operating activities. However, FASB wants us to use the direct method. It's a little bit more cumbersome to figure that out, but later in Intermediate 3, you'll learn both methods. We're going to focus on the indirect method. Okay? So normally, we need to know the income statement and the balance sheet. Our starting point for the indirect method is net income. What are we doing? We're converting net income accrual to net income cash. Now this is the direct method. I'm just going to go over it. Okay. Here is our indirect method. Using that information from 2 slides ago, so you might have to grab the slide from our PowerPoint within Blackboard. What we do is we go, okay, what's net income? Net income is 45. Then we look on our income statement and say, are there any expenses here or revenues that have no cash component? We never debited or credited cash when we recorded this. And yes, depreciation expense is one of those. So that should have, if we're converting accrual to cash, that depreciation expense should have never been subtracted. So add it back. Okay, it has no cash effect. Add it back. If there's any gains or losses from the sale of investments, those also have to be either added back or subtracted as if they never happened. Because those types of transactions are from investing activities, not operating activities. We don't have any of those. The next thing we do is focus on the current assets and current liabilities and how they changed from the beginning of the year. Those items are what impact our income statement accounts. So we start with accounts receivable. Did accounts receivable increase from last year to this year, from the end of last year to this year, or decrease? Now you could see there it says, oh, accounts receivable increased. And then you see brackets. Well, if accounts receivables increased, think of it, you would have debited accounts receivable. Think about doing the opposite to cash. You would have decreased cash. And that's what we're focused on here. What was the effect on cash from accounts receivable increasing? It went down. What's the effect on cash if a prepaid insurance increases? Well, that would have been debited. Credit cash. So when a current asset increases, the effect on cash is the opposite. What happens with liabilities? Current liabilities, we look at their change. If a current liability increases, you would credit it. Do the opposite to cash. So if a current liability increases, cash increases. And that's what happened with both those liabilities. If a current liability is decreasing, cash decreases. So they have the same or direct effects. So once we account for those changes in current assets and current liabilities, and add or subtract their impact on net income, that will convert net income into net cash flow from operating activities. So add back non-cash items on your income statement, and then take the change in current assets and current liabilities and report their impact on cash flow. So the net cash flow from operating activities for this company are 49. So we converted net income from accrual, net income cash. So operations gave us $49, 49,000. The next area of our cash flow statement is where we report investing activities. Investing activities are activities, cash activities related to our long-term assets, plant assets, intangible assets, and investments. Typical cash inflows are when we sell a plant or intangible asset. We sell an investment. We collect on a notes receivable, the principal. That would be positive cash inflow from investing. Cash outflows were when we buy plant or intangible assets with cash. We purchase stocks and bonds with cash, or we loan cash to other entities. That's how we invest in our company. And those are your typical cash inflows and outflows. We don't net them together. We show cash inflows. So if you buy an asset, a piece of equipment, and sell a piece of equipment, we show them separately on the statement of cash flow. Financing activities relate to the inflows and outflows from external financing. So we're looking at more long-term liabilities and equity. That's how we finance our company. So what kind of cash inflows would we have from financing activities? When we sell more stock for cash, when we borrow cash from our creditors, or we sell bonds. That's cash coming in from financing. What kind of cash outflows would we have? When we pay a dividend to the owners, when we reacquire our own stock, treasury stock, because now we're paying out cash in the equity area, when we repay on our loans, the principal portion. These would all decrease cash from financing activities. So here are examples. Here's an example for Arlington Lawn Care in their cash flow from investing activities. So this is starting right underneath their cash flow from operating. The only item they had was they purchased equipment. What's the impact on cash? It decreases it because they used $40,000 in cash to buy it. If that's it, that's all you report. The cash flows from financing activities. The company sold common stock. What's the impact on cash? It increased at 50. But they also paid dividends to shareholders. So they decreased cash 5. So the net cash flow from financing activities are 45. So cash increased 49 from operations. We showed you how to do that. It decreased from investing 40, and then it increased 45 from financing. So the net overall increase this year in cash was 54. So if we take the beginning balance of our cash that's on our balance sheet, which is 0, add or subtract how cash changed during the year, since it increased, we'd add it. That should equal the balance at the end of this year on our balance sheet, 54. So we show how cash changes according to our major functions of any business: operating our business, investing, and financing it. And those are your typical items that would be in each category. There are sometimes activities that are material to our company but don't impact cash at all, and they are still reported on the statement of cash flow. Here's an example. You buy a piece of equipment with a loan. You didn't use any cash directly out of your cash account. You signed a piece of paper and you got a piece of equipment. Well, that's called a non-cash investing and financing activity. You invested in a new asset with the financing, a loan. So we would still report it on the statement of cash flow at the very bottom in its own little section, just so people know, hey, they bought some stuff, but they didn't use the cash. Which of the following items would not be included as a cash flow from operating activity? Purchase of a machinery. That's a investing activity. Okay, and this brings us to the end of our presentation. Hopefully you have enough information to tackle the income statement, comprehensive income statement, and statement of cash flow. I'll be posting your practice problem. Please make sure you ask any questions that you may have on the discussion board.